next week, the big event is happening that we've been talking about. That's the Fed. Apple, of course, as you mentioned, one of the best quarters in the company's 46-year history, and yet the stock is down. That loss at Amazon, first loss since 2015, losing $3.8 billion. Actually, it was $7.8 billion when you consider the losses related to the Rivian stake. And then you've got oil companies out this morning, Exxon and Chevron, Joel, benefiting from this big move in oil prices. Your take on what we're seeing ahead of the Federal Reserve ready to raise interest rates again next week with that 50 basis point hike expected?
Well, a couple of things. One, I agree with your last guest that we're looking at, interesting times, and when we see the market pull back, maybe a chance to come in. We saw it, for example, yesterday, Meta or Facebook came in with fairly weak performance, but the stock rallied 17%, and that was largely based on valuations. When you look at Apple, which had a great quarter, and Amazon, I mean, we're looking at valuations very high. The difference between the two companies there, Amazon is priced relatively high to its peers, 2 to 3 times higher than its peers on a relative valuation perspective. Amazon came in very weak, and what we're seeing, many companies in this earnings season are really getting hurt on SG&A. These are costs that we need to be closely watching, particularly with the Fed coming out next week. The interest rates that they're going to, we're going to continue to see going up and up are largely a function of this inflation, which we're seeing in 3 areas, in labor and food prices and, of course, energy costs. The labor costs we're seeing creeping in financial services, and now we're seeing in some of the tech companies too. What was interesting is yesterday we saw Qualcomm, which is a fraction the size of Amazon and Apple, of course, but still a large cap company. They did very well. They beat across the board. Their relative valuation is very strong. So in the same category as Apple, one's going down, one's going up, and it's based largely, I think, on valuation. So to your last guest point, I think the valuations are a big issue. As we're looking at the inflation and the Fed going forward this year, we're going to see the long bond, which is not going up as much as the mortgages. So the mortgages have gone up 2%. Long bonds only the long bond for the Treasury is only gone up 1%. I think we're going to continue to see that long bond, the 10 and 30 year, rise more from 3 to 4% over the next month or so. And we're going to see the steepening of that yield curve and a shift up in the yield curve, I think.